This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody. While we are watching kind of a meh day in the trading overall for the equity trade, Boeing shares, though, a little bit lower, Tim, for a second day. The largest U.S. exporter continues to be on the radar of both investors and, of course, government officials after last week's fuselage blowout on a Boeing 737 aircraft. U.S. safety officials, by the way, will not rule out widening the probe beyond that 737 MAX 9. So TBD.
Yeah, shares of Boeing down 1.38% as we speak. By the way, Boeing ended 2023 with its largest ever monthly sales haul for the 737 MAX. Normally, an achievement like that, Carol, would be the cause for celebration.
Right.
Instead, the model is under increasing scrutiny after that near calamity on an Alaska Airlines flight on Friday night.
Yeah, it's kind of two steps forward, one step back, it always feels like for Boeing, at least for the last few years. Bloomberg News aerospace reporter Julie Johnsson is back with us on Zoom from Chicago, along with Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson at BI headquarters in Princeton, New Jersey. Stop what you're doing because you're going to want to take notes based on what these two say. Julie, kick it off for us. Latest news on Boeing, what we know, what regulators continue to explore.
Okay, Boeing's in a little bit of a holding pattern today. There's something going on behind the scenes between Boeing and one of the airlines and the FAA. And so until it's sorted out, airlines cannot begin the final inspection process, which would start to move planes back into the fleet and provide some clarity as to whether this is going to be relatively short-term and contained or
Julie,
bigger and messier.
Julie, after you were on... Okay, I just want to
Sorry?
jump in. I just want to jump in because after you were on with us yesterday, news emerged that Alaska Airlines and United Airlines had both found loose screws in the inspection of this part. What does that tell you about the manufacturing or the assembly process?
Well, United, in their release yesterday, was very quick to note that this points to an industrial issue. And the fact that it's in multiple planes is really, it's not a good thing.
Right.
For anyone.
All right. So, George, come on in on this. I've been thinking a lot about Boeing's supply chain. It's got to be a pretty complicated one. I would guess that there's really no room for error when we're talking about planes in the sky. So how are you thinking about this? And here we are several days after that Friday incident.
Yeah. So, I agree with Julie on this. It's apparently whatever failure we had in the assembly or manufacturing process, it was repeated enough times that would cause concern, I think, on the Dash 9 fleet. Thankfully, the Dash 9 fleet is only 225 aircraft, so it's relatively contained from that standpoint. But I think today the way we're looking at it as well is that, Spirit builds the majority of the fuselage, and we believe the fuselage comes with the plug in it to Renton. We know that we hear that Boeing takes the plug out on occasion to load the aircraft with, interior seats and things like that. And so there is a potential that the fastening wasn't done correctly, even up at Boeing. Either way, it's Boeing's responsibility to get an airplane out the back door of Renton that's airworthy and ready to fly. And just another indication of the challenges they're having both at Boeing and at the supply chain in producing aircraft that are, quality number one.
So, George, net, this could come down to worker error?
Yeah, I think it's going to come down to worker error, right? We'll see. My guess is it's probably not metallurgy of the fasteners or anything like that, because I think we'd have a lot more cases of this. Mm-hmm. So I think it's going to come down to worker error. I think there's a lot of turnover at both Boeing and suppliers during the pandemic. Post that, as that turnover occurred, as you replace those workers, management's responsible for training them well, supervising them on the line. Something broke down there, and we're seeing it, at multiple points, right? This is the latest issue. We had the bolt issue for the rudders over Christmas. We had rear pressure bulkhead issues last year. We had vertical stabilizer issues last year. So this is just one of a number of problems that we've seen in manufacturing.
I mean, Julie, contextualize this for us. I mean, the 737 MAX is the most important airplane to Boeing. We saw earlier, Boeing ended 2023 with the largest ever monthly sales haul for the 737 MAX. To what extent do the errors that George just highlighted, that you've been highlighting for us all day today and yesterday, do those put that at risk?
Yeah, well, we'll see soon, won't we? But absolutely, in terms of, for Boeing, the MAX is the commercial engine. It's really, it's where almost all of their backlog, and they've got thousands of orders for this plane, so it's their future. And this is the plane, that potentially helps them shed a crushing debt load and fund, new aircraft in the future. So to the extent that there's suddenly uncertainty around this plane and, how it's made, how it will sell, it's not good.
Well, and I guess when I think about airplanes, right, and carriers around the world buying them, it's Boeing and Airbus, George, right? So, there's an interesting Bloomberg opinion column by our Chris Bryant, who covers industrial companies in Europe. And he says Boeing becomes the poor relations and Airbus duopoly. Do you agree with that? And I do wonder how something like this, again, another concern about Boeing after several years of really serious concerns, does Boeing become even a bigger laggard potentially when it comes to Airbus?
Right now it definitely looks like a bigger laggard, right? And as we calculate backlogs, if we calculate them, based on number of years, and we give these manufacturers some of the future increases in build rate they think they've got coming, still Airbus, we think, has close to 9 years of backlog. Boeing closer to 7, right? So it is a duopoly. The silver lining for Boeing is, unless you want to get in the back of line at Airbus, it's probably not quite 9 years, because a lot of those airlines don't want their airplanes sequentially. They've got them out for a decade or more, but maybe it's 7 years of a backlog at Airbus. Unless you want to get in the back of a 7-year backlog at Airbus, you almost have to buy at Boeing. Right now, the quality isn't so bad that I think that's impacted. We haven't seen major customers walk away. Customers like Southwest, United, Ryanair, those are core customers, Copa, Alaska. But they really need to stem this, because it is, if you have a dual fleet, if you're flying like a Lufthansa,
right,
and you're flying Airbus and Boeing aircraft, I think you'd want to tend to Airbus right now, given the quality problems at Boeing.
All right, so Julie, in a company that has faced, we talk about the 737, the flights that crash, loss of lives. It's been several years of some serious concerns and problems and issues at Boeing. So what seems to be the problem? Is it still leftover lag from cost-cutting years? And what is it? Like, as investors are trying to kind of understand what happens next for Boeing as an investment?
Well, so in the next 45 minutes, what happens next for Boeing is the CEO is going to sit down and do a really crucial all-hands meeting, and just re-emphasize, I think, the core values for Boeing, and I think try to, set the tone for the next few days. So that's step number one. But in terms of the root causes, really super complex, and sort of all of the things that you mentioned. And I think we should give Boeing credit for, they have some really top engineering talent tackling these issues in their factory, but it's really, really, really complex and deep-rooted. They're trying to return to the way that they used to make planes in the early 2000s, which was really sort of peak Boeing,
right,
for, quality and reputation. Right. But it's just going to be a very long slog, I think. And, everything, disruption in the supply chain, worker exodus, it all contributes.
Hey, George, I want to give you the last word here. We got 30 seconds left. It's Airbus and Boeing, but China has been working on the C919 jet for more than a decade. in 20 seconds, is there ever a chance that this becomes a real competitor to Boeing and Airbus?
There is, but I think it's a decade away, especially in the Western world, at least a decade away in the Western world.
Yeah, those regulators got to approve it
All
outside
right.
of China, for sure.
Well, and as these guys pointed out, we should expect to maybe hear a little bit as this Boeing CEO gets ready to lay it all out, right, in an interview. All right. So appreciate it. Bloomberg News Aerospace reporter Julie Johnsson, and of course, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson. Guys, thank you so much. Boeing, as we said, down for a second day. This is Bloomberg Radio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right, super excited about getting to our next guests, I should say. This story, first of all, it's based on a most read story on the Bloomberg terminal today. It's about the Wall Street analyst who can deadlift more than 400 pounds, who has the ear of JP Morgan Chase's CEO, Jamie Dimon, someone who's gotten a handwritten letter from none other than Warren Buffett. And it's an analyst who has taken the coveted top spot in the institutional investor poll, a key barometer for Wall Street relevance the past 4 years.
We're talking about none other than Wells Fargo banking analyst Mike Mayo, the subject of a profile, Carol, by none other than Sri Natarajan and Bree Bradham. Mike Mayo joins us on the phone from New York City. Sri is here too, Carol, in the Bloomberg Interactive Brokers studio. He's Bloomberg News senior finance reporter.
All right. First of all, Sri, great story. Everybody's reading it. Mike, so great to have you here with us. You are a closely followed voice when it comes to the big banks, which, as we highlighted, has created some very unique and rare experiences for you. Letter from Buffett, Jamie Dimon's listening to you. What for you sometimes has you even saying, wow, this is a pretty amazing access that I have and recognition? How do you feel about all of this?
Well, first I'd say wow to the power of Bloomberg Media and what the research journalists dug up on me and the comments they came back with. But I will say it's a right and it's a responsibility. I have the right to call it the way I see it, but I also have a responsibility to do it in a balanced way. But in response to the article, to all the companies that I've analyzed that didn't like my conclusions or didn't like how I highlighted the shortfalls or didn't like when I talked about compensation or didn't like when I go to shareholder annual meetings and ask questions to management in front of their bosses, the board of directors, or just didn't feel like I was on their side. What I say to all those people and all those corporations is, sorry, not sorry. My job is not to win a popularity contest. My job is to call a spade a spade.
Why did you want to write? I mean, we know why you wanted to write about Mike. We talk about him when he has a call, but what was it that you wanted to get into, Sri?
I mean, arguably, he's one of the most interesting personalities on Wall Street. And here's someone who's been doing bank analysis, right? He's been a bank analyst for more than 30 years, in his fourth decade now. But more importantly, here's someone whose tales go back all the way from the shame of private jet travel with John McCoy, the original dean of Wall Street CEOs, to jousting with Jamie Dimon in 2021, 2022, 2023. He's still there. He's still very relevant. And it doesn't matter what these bank CEOs have to say about him. Privately, they do grumble. They say he has a penchant for grandstanding. They feel he's a bit of a showboat. They feel he's doing things to just needle them.
Sri, Mike's here right now.
Yeah, I
just want you to know, Mike's here.
Mike's in the room.
I will tell you, Mike and I have had several conversations about this. Mike would completely agree. That is how they perceive him. Yet the fact that he's called back for all of these operating committee meetings at these banks, for the management committee meetings, to talk to their senior leaders, to try and explain to them what they can do better to improve their stock. That tells you all about his staying power.
Mike, is that perception that Sri described, some analysts or some executives think of you, is that wrong?
Well, that's this idea. I'm glad we have counterpoint here in terms of...
You're welcome.
Anyone... No, in terms of grandstanding, showboating, and some of those other adjectives that corporations use, that's what I've heard now in my fourth decade as a Wall Street analyst. That's what I've heard from corporations when they're trying to control the narrative, when they're very closed-minded. So they don't necessarily say that to my face. So I will say I've been fired, I counted 3.5 times in my 30-plus years, and I have asked CEOs and CFOs directly like when I was fired from Credit Suisse in 2000, what they were saying about me. And they would just say, I think you're too independent for the new firm. And that's exactly what they said when I got fired then. But I would just say it's not one size fits all. So some banks get it. And so the one line I liked in the article, I didn't like it all, is the critical. And that's the way journalism goes. I get it. But the one line I liked came from Jamie Dimon. And Jamie Dimon said, differing opinions are okay. And guess what? When you have differing opinions, that's called candor. That's called culture. And in the case of JP Morgan, that's called success. On the other hand, you have a worst-in-class bank going back is Citigroup. The last 25 years, most of that time, especially the first 15 years, it was a very closed-minded culture, a groupthink culture. Don't challenge the leaders enough, and you see what has happened to Citigroup. Now, I think Citigroup has turned the corner. So if that's what they're saying behind the scenes, they're not always saying it to me directly, but over my 30-plus years, I have heard it indirectly or through consequences such as, like I said, being fired 3.5 times. One
little thing, in a world where it's hard to express differing opinions, it's really kind of refreshing to hear you say that. But Sri, come on in, because I'm sure you've got a million questions.
No, but just to Mike's point, I'd like to remind everyone, and this is now going back, more than 2 decades, but right when Jamie Dimon was coming on to become CEO of Bank One, I believe Mike had put out a report saying even Hercules can't fix it. And at that time, that bank felt Mike was rude and not sensitive to their needs, and they tried to ban access and not have him on various calls. Jamie Dimon came in and said, that doesn't make sense. We need to have him on his calls. You can't just revoke access. And oh, by the way, everything he's saying is probably right. Later on, when the JP Morgan Bank One merger happened, it was at an investor day in person. Jamie Dimon actually looked at Mike Mayo and said, Mike, where are you? Stand up, admit you were wrong. That is the kind of banter that the two of them have had. People have called them frenemies over the years. It's not like Mike is always complimentary about Jamie Dimon. It's not like he's always hostile to him, but he calls it as he sees it. And that's perhaps one of the reasons why he's been relevant for so long.
Hey, Mike, I wanted to talk a little bit about health and about exercise, and because part of the story talks about the powerlifting that you've gotten into just in the last few years. I did not know about this.
I didn't know.
So Sri and Bree write that you got to this after 2021, after learning that you had osteoporosis and realizing that you'd broken 15 bones over the course of 5 years. Can you just talk a little bit about your routine and sort of how powerlifting has it improved your life and sort of the balance between athletics and banking? I know, Carol, you want to
I want to get into that, but I just want to mention a headline, the SEC granting approval for Bitcoin ETFs.
Okay.
So, Mike, feel free where you want to go. You can talk about your workouts, but you can also talk about kind of the changing landscape of the financial investment landscape, because I'm wondering if you have any kind of comment on that.
Well, I would say that the job of a Wall Street analyst can be very intense, stressful, dynamic, sometimes with long hours when you least expect it. And so, I now work at a Wall Street division of a Main Street bank at Wells Fargo. And, they encourage a work-life balance, and I need it. And so this is my outlet for that. And I was raised during the 70s when it was all about, the book of running, and I ran marathons, and I did cycling. And the last few years, as your body talks to you, you adjust. And, my bones are weak, and I needed to strengthen my bones and do a pivot. So my pivot was to get into strength training and specifically powerlifting. And, I guess I'm that stereotypical person on Wall Street. Like when you go into something, you go all the way. And so it wasn't enough for me to do this. I had to go ahead and compete. So I competed in my first meet a little over 2 years ago, and I got disqualified. I failed. So I missed my first 3 attempts, but then I went back and I went to nationals last year, where I placed second and broke into the 1,000-pound club. That's squat, bench, and deadlift. But the average person loses half their muscle mass between the ages of 40 and 80, and so as you age and it starts to get you and bite back. And I'm hitting PRs, personal best records, even as I get older. And so I think the story about strength training has been underrepresented in our society. I feel like an evangelist for strength training and powerlifting and all that comes along with it. But the genesis of that is the need to have a work-life balance when you work long, hard hours on Wall Street.
And I will quickly add that I think Mike's biggest disappointment in the story was we mentioned his performance at the Memphis meet and not his personal best that came a few months earlier when he did break into the 1,000-pound club.
Well, a fun read. And Mike, so glad that you could join us as well. Of course, Mike Mayo joining us, Wells Fargo banking analyst with our own Sri Natarajan here at Bloomberg News.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I always feel like somebody's watching me, and I have no privacy. Oh, I always feel.
Hey, did you know that Bloomberg Intelligence tracks some 2,000 companies in sectors ranging from finance to food?
They watch a lot of stuff.
We got a great team. It's like the in-house analysis group, Bloomberg Intelligence.
It absolutely is. And you know what they did, Tim?
They found 50 companies.
Yep, that warrant a closer look based on BI's list of focus ideas.
I knew this because it's an annual tradition that Bloomberg Businessweek does. It's a deep dive at the beginning of the year. It combines contrarian views and upcoming catalysts for change, such as new leadership, asset sales or acquisitions, perhaps plans for new products and services, too.
Well, the feature is in the upcoming new year-ahead issue of Bloomberg Businessweek, available on newsstands later this week, already online and on the Bloomberg terminal. Let's get to it with Tim Craighead, Senior European Strategist and Director of Research Content for Bloomberg Intelligence out there in London. Joel Weber is the editor of Bloomberg Businessweek. He's right here in our Bloomberg Interactive Broker studio. Joel, always do love this list and how it comes together. Remind our world who are watching and listening how it does actually come together, how these names are chosen.
Many conversations, and the analysts at Bloomberg Intelligence, just a great team to work with. And effectively, if I could condense what this project is, they take their whole universe and then squeeze it through a spreadsheet, and what you're looking at is what comes out on the other side. These are not buy-sell recommendations. We're not going to go there. But we do think they're ones to watch. And we've been doing this project for years with this team. It seems like it gets better and better every single time we do it. We do quarterly updates now. A lot of these are these focus ideas that the team has a ton of conviction about. And we're looking often for like things that appear like catalysts, especially as we go through the year and do these quarterly updates.
Which would be good for a name or bad, right?
Or bad, yeah. And there's something that feels almost like a trigger. This group, though, this is as big as we get. We do these 50, and it really feels like we're trying to reach around the globe, give you some discoverability. Like there will be companies that I think we're going to talk about right now that you will have never heard about. Carol, I expect you to chime up when that happens. And then there are other ones that you're like, okay, what? I know this name, Alphabet, but why this year? But big thanks to Tim and company in advance. One of the things that I think we would be foolish not to consider is coming off of last year where artificial intelligence became such a dominant theme. There's a whole group of companies within the 50 that sort of are first and foremost going to be AI stories, Tim. So why don't we just start with that? We have not, when you come to this online or at the terminal, this list of companies is just going to be alphabetical, but we did a little bit of a courtesy here, some modest groupings so that we could kind of talk through some of these companies. So Alphabet and artificial intelligence, is that they're not the front runner right now, right, Tim?
Yeah, well, I have to say it's really interesting. Thanks for having me on. Artificial intelligence had such hype in 2023. You kind of think, okay, so what's left? Why is this a big deal now? And you might think about that chart of the Gartner hype cycle. And, are we right at the top before it crashes into, overdone? We don't think so. And there's two elements to this. And actually, we just published a pretty important chief information officer, CIO survey over the last couple of days that signaled that companies were just modeling things in 2023 and they have significant plans to accelerate actual implementation in 2024 and 25. At the same time, we had a tech spending cycle that was in a lull in 2023 that we think also will accelerate later in 2024. And if you take those things together, companies that are in the eye of this opportunity are a big deal. And there's a couple of elements that play into this, and it is the biggest bucket, if you will, across the 50. There's infrastructure companies like Alphabet. They are creating the infrastructure, Bard, for example, or Gemini, in terms of different programs and whatnot that you can use generative AI with your business. Amazon, you think about their retail, but actually one of the biggest businesses they have is their cloud business that supports AI applications for companies. Accenture is a big IT services company, and they're a consultancy that executes on programs with companies that need the advice and counsel. So that's one level, and not to go too crazy about this, but then you've also got applications that you think about, Intuit, TurboTax. If you use that to do your taxes, they're starting to implement AI within their programs to make tax prep easier. We all know how complicated that is. Match, okay, this is a fun one. Tinder, Hinge, if anybody's listening who uses these dating apps. There's AI applications being folded into Tinder for better photo selection. So there's all sorts of stuff going on here from AI that we think will gather steam.
Well, and I can't wait for the matchmaking to go there, but we'll start with photo selection.
Oh, really? Be careful what you wish for. I just want to point out, NVIDIA's not on that list, but it's already the 6th best gainer in the S&P 500, number 6 on the list, which was, the top gainer. Yep. But you do have a name in that list, which will all take us back to the 70s, or some of us back to the 70s. Disco? What?
Have you heard of Disco?
Well, yes.
No, but have you heard of the company Disco? Be honest.
Who are they?
So Disco is in the semiconductor equipment business. It's a Japanese company. And essentially, as you make the semiconductors that fold into NVIDIA solutions and other advanced semiconductors that support AI, you have to have special equipment to make those semiconductors. And Disco was one of those key companies in the equipment cycle, along with some others. But we think that this is one that is not quite appreciated for the opportunity in front of them.
I just love that there's this whole suite of companies in artificial intelligence that, suddenly a chatbot comes along, and now we're talking about, 3, 5, 10 years out. These are some of the companies that I think you're going to be talking about a lot more. Okay, another big theme, Tim, as we look into next year, is these expected rate cuts from the Fed, but Fed's not alone. There's also going to be some pivots at other central banks. Who are some companies that could be winners and losers out of that?
Yeah, I'd say this is another interesting one where we had interest rate stories last year, as you might recall, but they were margin expansion stories because interest rates were going up, and that's generally good for financials like banks. This year, with the prospects of the U.S. Federal Reserve or the Bank of England or the European Central Bank pivoting to start lowering interest rates, then it's the opposite. So we actually have a broad industry negative focus idea on margin or profitability prospects for European banks. And Barclays, one of the big UK banks, is a poster child of that. It also plays into the insurance business, and we have AXA on the list. And not only do you have the falling interest rates, but there's also some industry regulatory changes that are occurring that should make insurance companies more interest rate sensitive. And so if you do have a reduction in interest rates, it's more likely to flow through into your earnings. And so we think that complicates the insurance industry, or AXA's case in point. That said, on the flip of that, housing across elements of Europe and certainly the UK specifically have been under pressure, and home builders have suffered. Housing starts are down a lot. A company named Persimmon is on the list under the idea that it's likely to do better than what's anticipated from consensus as interest rates fall and home building starts to pick up again.
That was a name I had not heard before the list. Why I love the project. It's like,
Do you like Persimmons?
I do, but they're playing
That's where
some
I'd heard the
affinities there. But
The ADR trades in the United States. You can tap into it.
Truly, it's just like one of these things you would have never probably ran across
No.
a company like that.
Isn't
and like
that a
lo and
color?
behold, in the middle of it all is a little bit of analysis.
Tim, I got some. There's some companies on here too that I think we're all familiar with. Aston Martin is a company that is categorized as releasing new products. Talk to us about why Aston Martin is one to watch.
Yeah, I tell you, if you look at Aston Martin, it IPO'd back a couple of years ago, and it's been a bit of a dud. They've disappointed, even though you know the company and you can visualize the cars in a James Bond movie, and they're super cool. It's not quite executed the plan of what was hoped. And as we look into 2024, they've got new sports cars coming up, and they've got great names. The Vantage 12, it's a 12-cylinder car, or the Valkyr, and there's others. They got an SUV, an Aston Martin SUV. And these are all, we think, accelerating growth. They're super high margin products, and we think that that's not yet to be fully baked into what the market's thinking.
Okay, so let's see. We've got some M&A. How if that goes down? If we, deals were not exactly high on the list in 2023. If 2024 looks better, like who's to watch?
Yeah, so the ones we have on here from an M&A perspective are taking advantage of transactions either that have lined up or that they have planned. So in the world of energy, Exxon made a very large purchase towards the end of last year to increase their exposure to the Permian Basin, big oil production field in the U.S. And this is going to be a year where they can start to execute on that. And, they have underperformed in terms of their financial performance, the likes of Chevron in various ways. And, this should be an opportunity for them to step things up. Energy transition and all that sort of stuff setting aside. SABIC, Middle Eastern petrochemical company, has also had a big steel business, and they're getting out of their steel business, which should allow them to focus in on petrochemicals specifically. And we do think that there's a fundamental upcycle there going through the year, in particular in the second half.
Yeah.
So those are a couple of elements there.
Well, hey, Tim, just got about a minute and a half left here. Consumer products, we're all focused on the consumer. Can they keep spending? But there's been a couple of companies, I think about Estee Lauder, that's been trying to kind of figure its way forward. You're watching that, Diageo, Aritzia. Just quickly, give us some thoughts on those.
Yeah. So there are a whole host of good, big, quality brand companies. If you think about the products themselves, Estee Lauder Cosmetics across all of their brands, Diageo owns a number of high-end spirits. And they've come under pressure over the course of the past 6-9 months for a variety of reasons. Estee Lauder had excess inventory in Asia. Diageo had too much inventory in the US. We think that this is a year where that gets normalized, and the underlying business of quality, high-end product will play through with those two companies, and they'll play catch up.
And I have to say, Aritzia, that Super Puff parka, my daughter had to have it. It comes in many different colors.
Who makes this one?
Yeah, they're
Aritzia.
Expanding rapidly across the U.S. from a Canadian base.
Really cool stuff.
Mm-hmm.
Love this list.
Well, last little piece of the puzzle, energy transition. We're going to be short on time, but First Solar, BYD, Glencore all on that list. There's many more categories and companies. What's so great about it is you just get through this and then you go back to it at several points in the year and you're like, oh wow, look what they were talking about at the beginning of the year.
Hey,
So,
pay attention to us.
Yeah.
yeah,
Okay.
you know,
That's what
it's
I'm
a
saying.
thing.
Guess
It's
what?
a thing.
We're actually smart.
Humble brag.
Well, the Bloomberg, let's not get ahead of ourselves.
it's the Bloomberg Intelligence team
and
is smart.
Businessweek,
Yeah.
they're the smart ones.
All right, great stuff. Check it out online on the terminals and the upcoming new issue of Bloomberg Businessweek, the year ahead issue. So appreciate it. Joel Weber, of course, editor of Bloomberg Businessweek, and Tim Craighead of our Bloomberg Intelligence team. It's a killer list.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody. Charlie breaking down the market trade here, just rolling over our best levels of the day, but nonetheless down across the board on those major equity averages. And this on a day where we continue to see a 10-year that has stayed right at pretty much 4% here. So what's interesting is we've had a lot of commentary coming in to the Bloomberg News team. Bill Gross signaling he is steering clear of treasuries, calling 10-year debt, Tim, overvalued.
Yeah, let's get some thoughts on that from the senior portfolio manager and head of U.S. fixed income at RBC Global Asset Management. Andrzej Skiba joins us on Zoom from Stamford, Connecticut this afternoon. Andrzej, good to have you with us. I want to start with what Carol just talked about. Bill Gross, the former so-called bond king, signaling that he's now steering clear of treasuries. What did you make of what he had to say? Is the 10-year actually overvalued?
Well, thank you for having me. We do think that this rally can indeed stall a bit, but we do not believe that it is over. So we're going through this period of consolidation right now after a fierce move that we have seen in the last 8 weeks. Market just needs to take a bit of a pause. And we also think that the incoming inflation data could surprise being slightly higher than expected. So in the very near term, some consolidation is actually quite healthy to be seen.
Right. And so as we consolidate, Andrzej, what do you think is a real level, especially as you cited some concerns about maybe a little bit of an uptick in inflation that could surprise the markets? So with that backdrop, what do you think is a really smart level on the 10-year for, I don't know, the midterm or how you're thinking about how it trades in 2024?
Well, let me tell you this way. We have a lot of investors who would absolutely love to buy 10-year treasuries anywhere close to 4.5%.
I bet.
We do not think that is likely to happen over the coming weeks, but we do believe that if we see 20, 30 basis points back up from current levels, that will be met with a lot of demand from those fixed income investors who missed the party in 2023.
Yeah, the party was short and quick when the 10-year moved up higher to peak in October, of course, Andrzej. Do you think that in the near future we get to 5% on the 10-year? Not in the coming weeks, but maybe in 2024?
We find that very unlikely. And the key reason for that is that a lot of components that drive inflation are indeed moderating. So as long as the inflation story beyond the hiccup over the coming weeks, as long as the broad inflation story for 2024 indicates moderation, we do believe that Federal Reserve will be in a position to cut, and therefore yields could come down further.
You know, what's interesting too, we mentioned Bill Gross, but the firm he created, PIMCO, also out on Bloomberg and a call with some commentary on the bond market and saying bond investors can still reap equity-like returns in 2024 despite the steep declines in yield from last year's highs. So it sounds like you kind of agree with that as well, or I don't know if you would say equity-like returns, or do you?
Well, when you look across fixed income universe, all the way from high grade to high yield opportunities, we do see high single digit or even low double digit returns as possible over the coming 12 months. So yes, I would agree that from a total return perspective, the outlook for fixed income remains attractive. It's just that some of the easy money has been made in the recent 8 weeks.
All right, so where do you want to be in the curve right now?
Well, we do like the belly of the curve. We do believe that investors want to have exposure to duration because in order to get those juicy double-digit returns, you need to take on some duration risk. You can't stay just at the very front end of the curve. And that's why we recommend to our clients to gain exposure to credit in many manifestations, but with more duration than just the very front end.
Given what we've seen from fixed income over the last few years, how do you think investors, versus what we saw at the end of 2023, how do you hope that investors' attitudes around fixed income has changed this year?
Well, investors have seen that the asset class can perform again. I think 2022 was a very painful period for many investors. People did not expect double-digit declines in an asset class that was supposed to shield them at a time of dislocation. So seeing double-digit or close to that positive returns in 2023 was definitely quite welcome. And since we expect similar magnitude of a rally in the context of this year, we think more and more investors will decide to take money out of things like money markets and put it in longer duration opportunities within fixed income.
In terms of just broadening it out a little bit, high yield or corporate, when you look at other sectors of the fixed income market, Andrzej, are there other parts that you find more interesting here in 2024?
So look, from our perspective, we see similarly high returns between high grade and high yield. We do admit that it's easier for many investors to pull the trigger on high-grade companies into a potential economic slowdown than it is in the case of high yield. However, we also see that high-yield investment universe has very, very strong technicals. There is very little issuance in high-yield bonds. Vast majority of companies have refinanced in 2020 and 2021. So there are very few maturities coming due, which means that only a small increase in demand for high-yield assets can lead to positive price action within the space. So we absolutely understand why many investors find it easier to buy high grade, but high yield looks pretty good to us as well.
Hey, Andrzej, we only have about 20 seconds left, but just give us your view on how many rate cuts we're actually going to see in 2024.
In our opinion, less than is currently priced in. We're pricing in 150 basis points of rate cuts. We think that number will be less, maybe 100 basis points. And those rate cuts will start a little bit later than March that is currently priced in, but they're still coming.
Okay.
So appreciate it. Interesting. Yeah. It does feel like so many, there's so much expectation, so aggressive thinking in terms of rate cuts.
At the end of the year?
Smart call. Andrzej Skiba, thank you so much. Senior Portfolio Manager, Head of U.S. Fixed Income over at RBC Global Asset Management.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.